Hey there! Welcome back to Ematicus Learning. Ever wondered how a simple change in currency rates can shake up entire economies? Or why businesses are so concerned about exchange rates? Today, we are diving deep into the fascinating world of exchange rates and how they influence global business, trade, and investments. Buckle up, because this is going to be an eye-opener. Here's what we are covering: what exchange rates are, how they are set, and their huge impact on international trade and big companies. And yes, we have got some crazy real-life examples to make this super relatable. Let's start with the basics. So, what's an exchange rate? In the simplest terms, it's the price of one currency in terms of another. Think of it like this: if you are traveling to the US from Europe, the exchange rate tells you how many euros you need to buy $1. This isn't just important for tourists. Businesses rely on these rates to make money. Imagine an Indian company buying goods in US dollars. Suddenly, if the dollar becomes more expensive, their costs shoot up. So, exchange rates directly impact costs, prices, and ultimately profits. Now, who decides these rates? This is where it gets interesting. Exchange rates are set by supply and demand in the Forex market, where currencies are traded just like stocks. But central banks like the Reserve Bank of India or the Federal Reserve in the US also step in to stabilize rates when needed. For instance, if inflation is high in a country, the central bank might raise interest rates to control it, making its currency more attractive to investors. This increases the demand for that currency and strengthens it. But when the bank wants to boost economic growth, it might lower rates, making borrowing cheaper but weakening the currency. Exchange rates haven't always been as they are today. Did you know that before 1971, exchange rates were fixed to gold? It was called the Bretton Woods system. But after that collapsed, currencies were free to float, meaning they could go up or down based on the market. The 2008 financial crisis and the Brexit in 2016 are just two examples where currency values fluctuated wildly. Events like these show just how connected global business is to currency values. Exchange rates play a crucial role in international trade. Imagine two companies, one from the US, one from Japan. If the dollar strengthens against the yen, Japanese goods become cheaper for American consumers. But if the yen strengthens, American companies might have to pay more for Japanese products. Take the auto industry for example. A weaker yen makes Japanese cars more affordable in the US, boosting sales for Japanese companies. But when the yen is strong, it can lead to higher car prices abroad, impacting sales. Now, let's look at multinational companies. These giants operate in multiple countries and deal in various currencies. A shift in exchange rates can boost or reduce their profits. If Apple earns in euros but reports in dollars and the euro falls against the dollar, Apple could see lower earnings. To protect themselves, these companies use something called hedging. It's like an insurance policy against exchange rate swings. They might sign contracts to lock in exchange rates or use financial instruments like options and futures. Let's bring this concept to life with some real-world cases. In the 1997 Asian financial crisis, several Asian currencies collapsed, which threw international business into turmoil. And then there's Brexit, which caused the British pound to plummet overnight, impacting countless businesses. To wrap up, exchange rates are a big deal in global business, shaping everything from pricing to profits. Whether you are an investor, a student, or a business owner, understanding this gives you an edge. Thanks for watching. For more deep dives into finance, don't forget to subscribe to Ematicus Learning. If this video helped you understand the world of exchange rates a bit better, give it a thumbs up, share it with friends, and hit the bell so you don't miss our next video.